COP17 is underway in Durban, and joining me live from the venue to discuss the future of carbon markets, Marco Lotz, Sustainability Carbon Specialist at Nedbank. Marco, thank you very much for joining us. Let's just take a look at these carbon markets and break it down. We've got carbon markets really divided into two parts. You've got the largest being the EU emissions trading scheme, where certified emissions reductions are sold, and then you've got the voluntary carbon markets. Break it down for us.
Samantha, good afternoon. Well, I think it's very important to start exactly where you started, to say that there is actually a spread of carbon markets. The UNFCCC, COP17 year behind us, that is all to do with the compliance market. So that is where countries took a voluntary cap on their emissions, and then if they pollute too much, they have to trade, and if they pollute less than what they're allowed to, come on company level, they can actually bank the emission reductions or trade it. Completely on the other side of the spectrum, you've got voluntary emission reductions. Now, this world is riddled with three-letter abbreviations. You get VERs for voluntary emission reductions, and you get CERs for certified emission reductions. Now, voluntary emission reductions can start as simple as if you log into a gym website or a aircraft, if you're booking a plane flight somewhere, you can actually voluntarily give a bit of cash part of your ticket to actually go to various projects. It can be as simple as planting a tree, and it can go up to the complete right-hand side of the spectrum, which are very, very complicated emission reduction schemes. So that's in a nutshell, two widely a broad overview on the carbon markets and how they actually differ.
Now, California has recently launched a cap and trade market. It's the most predominant voluntary market in the United States. You've also got Australia looking at a voluntary market. What needs to be in place to grow the spectrum of voluntary carbon markets?
Okay, so first of all, we should focus on the fact that the voluntary market is in fact voluntary. So many of the mathematical models that these voluntary schemes use, they actually copy and paste from existing cap and trade schemes, like the UN-based certified emission reduction scheme. Now, for voluntary initiatives to actually expand, we actually need consumers to also partially change their behavior. And let us not underestimate the value that the man on the street, your viewer of this program, have on climate change and on the climate markets. So there is also the debate that obviously the voluntary market can only do so much, because it's a bottom-up approach where people voluntarily do something better, maybe buy a more efficient fridge, or maybe donate some money for a fund, as opposed to the compliance market, which is top-down, which is regulated by government, and companies actually need to comply to it. So there's a spectrum of offsets, and it's a very interesting road going here to see how these markets actually merge, if they will merge in future.
If they do merge, and we'll get to that just now, but just let's look at the compliance market, that of course the European emissions trading scheme, that accounts for 84% of the current global carbon market. And of course any rules and regulations here guide where we see the carbon markets going. What have been the key changes that have been proposed so far that have changed the dynamics in the carbon market, and especially relate that to the future of the Kyoto Protocol?
Okay, the Kyoto Protocol is not in danger, but the first commitment period of the Kyoto Protocol is expiring in 2012. So at these COP meetings, we're now at COP17, we are aiming to get countries to sign up to the second commitment period of the Kyoto Protocol. Now, obviously, between COP15, 16 and today, there's been a couple of changes. We've got the world economic situation where we are today, which is obviously vastly different than, say, 5 years back. We also have got the idea that, or historically we had the idea that people that polluted in the past, developed countries, should actually fork out the complete bill to actually get climate change mitigated, and some adaptation also. But now we're getting to a point in history where developing countries are growing so fast that they actually need to pick up part of the tab. And this is the interesting debate that's happening just behind us. It's a very, very difficult debate, but very interesting. What has also changed is, in the past we had developed countries and developing countries, but that binary split doesn't seem to work anymore. We now have least developed countries, somewhat developed countries, and developed countries. And how do we cater for those in-between type of countries, like South Africa, where we are part of BRICS, or BASIC, if we want to call it that, and we are growing faster than least developed countries. We've got more infrastructure, and how do we actually deal with that from an emission basis? Do we need to have a cap as South Africa? And what about least developed countries? Should they still be exempted from a cap?
Yeah, that's of course the big question really this year at COP17. Let's just look at the viability of merging these voluntary markets, which are a much smaller portion of the overall global carbon market, and then the compliance markets. What are the key issues there?
Well, the key issues will be how do we get this bottom-up approach, which is the voluntary market, and the top-down approach to actually meet somewhere in the middle and eventually merge. Now, in the end, governments need to represent their constituents, and their constituents at this stage are facing economic hardship, especially in Europe and obviously throughout the rest of the world as a ripple effect. So to get these markets to merge, we actually need the viewer, the man on the street, to change behavior when purchasing goods, to use electricity wisely, to invest their money where it is got more sustainable type of background, but not at the cost of profit. It's just investing in greener and more sustainable ventures. And if we get that going, the markets could eventually merge.
Marco, before I let you go, of course you come from Nedbank, and today Nedbank has launched the first green ETF in South Africa. Investors can now get investment in sustainable initiatives. This green ETF, though, has some of the largest polluters in South Africa, that being Sasol, which is the second largest polluter, Sappi, Mondi, Goldfields. Explain that for someone who doesn't understand how this ETF works.
Okay, the ETF is based on, first of all, it should be listed companies on the Johannesburg Stock Exchange, and second of all, they should have a certain rating in the Carbon Disclosure Project, the CDP. So these might be companies that at this stage do pollute, but at least they are open and upfront about it. They actually say what they do. They measure their pollution and they reduce their pollution. And then in the ETF, they also have got a kicker, a so-called additional accreditation or ranking for companies that's got a CDM, a carbon or a clean development mechanism scheme. So companies that actually see the opportunity that you can make money through being sustainable. We're not debating the fact that some of the mining houses and some of the petrochemical companies are on that list, but from a job creation, from a sustainability point of view, they still need their space in the greater economy.